Hello guys, how's everybody doing? I know it's been a while since we made previous YouTube video. So today we're back again, man. Let's try to see what actually happened back in the days on different pairs. Let's try to look at various criteria that made some of the movements. And yeah, so starting with gold. Actually, gold had a hell of a movement. We had a market shift on this point right here. Also, we had this formation, which is an offside formation. Point, the validation point. Also, we know that for the market to count liquidate the weekly area of liquidity, we have to have a shift on the 4 hours time frame. So coming to the 4 hours time frame, first of all, we had a shift on this area right here. I will discuss the FTA. We had this highest point, we had this market shift right here. And also we had formations. We had this outside formation right here. So this was the outside formation, validation point and validation point. So coming to the, let me try to cut this chart first. Coming to the 30, we had to refine this entry. And refining on this area, the visible clear liquidity engineering available at the moment was located on this point right here. I usually don't, for example, when I'm looking maybe at the certain specific criteria, and I'm having a situation where my liquidity engineering maybe has been tapped maybe more than once or more than twice, I don't consider that, because liquidity engineering is not a zone. Liquidity engineering is not liquidity, actually. I don't know if you understand that concept. So I usually ignore those reactions. Yeah. But looking at this clearly, I remember this entry, I took it from this zone right here. My masterclass students know why we took this entry based on this zone right here. So later on, the market tapped into that area. But luckily, even if you didn't get this entry, we also had a shift on this point, and also we had this zone right here. So you would have taken maybe the second agglomeration or whatever from trading on this particular point. So that's how gold now started to drop. So gold went down almost how many pips? From here to here, almost 630, 632. And it had to move because it is the only way that the market had to do so that it can actually go to liquidate on the weekly area of liquidity. So after the market approached the weekly area of liquidity, observe clearly here, the market later on came and performed another shift, as you can see. But this area of liquidity right here gave us also another entry. No, it was not this one. After the market performed a shift on this area, the shift was actually located on this point right here. I don't know how you guys have been taught how to spot these shift points, but I usually spot this shift on my way. So after the market performing a shift on this 4 hours, that means this bearish idea died and the market went up. So we have to wait, because the liquidity was not enough for the market to maybe come to create this new high. When you spot any of the shifts from the 4 hours time frame, we go with it. So later on, the market came again now, performed another shift on this point right here, and the market left us with this outside formation, as you can see. Outside formation. And if you observe clearly, we have this outside formation. Let me mark it by blue. And on 30, we had a clear liquidity engineering, which was available on this area. Going on 5, this is gold, you have to refine. we had this another liquidity engineering right here. Yeah. So later on, the market came again. Let us do the simulation, but we don't waste any of the time. Market later on came, the market moved around, fucked around, the market later on came and did that entry. So that was the entry taken from this area. And remember, always this 4 hours shift, they usually try to take this pair or take a specific price to the specific constant time frame. So that's why the market had to drop. Later on, the market performed another shift, what we call a continuation shift. It was located on this point right here. And also we had this, an outside formation, we call it. So after the market left us with this formation that we are actually having at the moment, we go now to the 30 to try to refine this area. I remember the first entry was taken based on the 4th agglomeration. I won't disclose that. But we would have taken the entry based on this liquidity engineering available in this area. And later on the market came. First entry was located from the what we call the 4th agglomeration. With all due respect, I won't disclose that, but later on the market came to this liquidity engineering that you have marked on this area right here. But before the market came to activate that entry, the market also tried to go inside the weekly area of liquidity. So that means when the market performs a shift on this area, we are going for the second agglomeration, the non-confirmation of liquidity flow. We are going for it. We had this formation right here, but the market it took this entry, but the market later on came and break even. That is not the case. But later on also we had another formation on this area. And on this formation, we had this going on 30. We had a beautiful liquidity engineering available on this point right here. So we had to mark this, and in terms of risk, I usually use 15 pips as my stop loss. I don't use more of that. So regardless what the market structure provides me, I usually deal with my 15 pips as my risk, because I know when the market stops me out by 15 pips, then I was completely wrong on that specific direction. So coming into it, we had an entry on this black line right there. The market later on came, activated that entry. As you can see, the market started to go up. So you're going to take that entry, and also your take profit is going to be somewhere here, almost 550 something pips. And also when the market approaches to that area, we are going also to sell. As above, so below, as within, so without. You're going to sell on that area, almost 15 pips as usual, 14.6, that's safe. All in all, the market has to do is to come and enter this, what we call it, the weekly area of liquidity. So the market later on went up, the market went up, the market later on hit the TP from the entry that you actually anticipated. Later on, the market activated this entry. As you can see, when I extend this anticipator right here, the market later on came. So 550 pips going up also. The entry from the selling has been activated again. And this now, your take profit is going to be on this area because we are having a shift, a 4-hour shift inside the weekly area of liquidity. That means we are going to take this entry based on the second agglomeration. It's the entry that we are currently holding right now because gold has to create a new high. And this is going to be our final TP for this entry. The entry that was taken, I remember it was maybe last week, if not. So on 30, we had nothing clear to see on this area. But going on the 5, I remember a lot of people missed this entry because they took the liquidity flip from the 30 minutes time frame. But going to the 5 minutes time frame, we had a clear, beautiful liquidity flip. clear, beautiful liquidity flip was available on this area right here. Liquidity flip was located on this area. Had this liquidity flip right here, and also our stop loss was located on the body. From that point, measuring the risk had was almost 23. I wanted 2 pips according to structure, but I usually use only 15 pips as my stop loss. Yeah, so after the market performs a shift on this area, this bullish activity right here is invalid because the market has already performed the liquidation process. So you're waiting for the entry, on this area, waiting for the entry on this area. Let's mark on this, yeah. And as usual, only 15 pips. No, only 15, that sticks. Yeah, 15 pips. So, and this is the entry that is currently running. So all of this activity right here are nonsense. Have to wait for that entry. So now the market went down. If you remember, we took this entry last week. So the market came and activated the entry. As you can see, this was the entry that was activated. So you are hitting a TP from the previous entry, which is almost 800 pips, 803. And you are now entering on this second agglomeration entry. And your target has to be on this particular area right here. So the market started going up. Saving it from the daily perspective. Also remember we took some sort of entries on specific areas. I don't remember where. I try to look at it. So all of the entries that you're going to continue taking are just based on the what we call as the continuation phase. Just have to observe those shift points, and also you're going to take those entries as usual. So currently we are running on almost 1,034 pips, but the main target has to be on this area. Unless the price performs a shift on the 4 hours time frame, we are going to go out of that trade. So that is all about gold. Let's try to look another pair. What we have. We also have a GBPJPY entry that was taken. I remember it was from previous week. Okay, so we are discussing this GBPJPY. So looking at the bigger picture on this specific pair, we are having weekly time frame. We are having this beautiful weekly area of liquidity. And as we know, the market is a slave to liquidity. So the market has to perform a shift on situational time frame so that you can actually counter-liquidate this weekly area of liquidity. So coming out to the 4 hours, I won't go deeper on specific criteria like the what we call as the FTA or the liquidity consumption or various or how to select this what we call as the liquidity engineering. But market performed a shift on the 4 hours time frame on this area. Also, we had this formation. On the 4 hours time frame. So on 30, a lot of people took the entry. A lot of my students took the entry on this area based on the liquidity flip. But the clear validation point, I remember why. I know why. I know why those guys took the entry on this area. But the clear validation point of the market performed on this point right here. When you go to the 30 minutes time frame, the liquidity flip was available on this area, and it's normal taking the liquidity flips. But I wouldn't recommend these liquidity flips because of the reasons that they know, because of the nature of the movement available in that area. So 60 pips is more than enough. But also, you could have taken this entry based on the 4th agglomeration, but also clearly on the normal level of understanding, when you go to the 5, we had this liquidity engineering. A lot of people are going to ask, bro, why didn't you take the liquidity nearest with fathom deviation, which was supposed to be this one? A lot of people know the reasons why we took this liquidity engineering, and the market later on came and activated this entry, and the market now started to go down. So that's how this GBPJPY pair was taken, and the market is currently running how many pips? Let's try to count. How many pips? So the risk was only 5 pips, and the market went down almost 187 something. So we're going to go out of this trade if we maybe spot a shift from the bullish perspective. That's where we're going to go out of these trades. Let's look another pair. We also took the USDJPY. I remember the entry was located on this point right here. It was just an intraday trade. Taking this entry, we had a shift on this area, and also we had a formation. So going to the 30, on 30 we had nothing on this area, but also going to the 5 minutes time frame, we had this liquidity engineering right here. So normally on the normal basis, we would have taken maybe that entry based on the 9 pips as your risk, but refining even more, you could actually take some sort of, I think I don't need to explain that because that's the fourth agglomeration. A lot of people know what to do on this area. So you would have taken that entry, and the risk was almost 9 pips, which is more than enough. As you can see, only 9.5 pips as your stop loss. And your first target was supposed to be on this area, on this previous high, which actually the market came. So you would have taken almost 1:7, which is more than enough. We usually take what we call as 1:5 minimum. So on this high, the market came, as you can see, tapped into those areas that the market now started to go down. On the clear picture of this direction buyers, would have actually have to go to maybe the higher time frames to observe what is actually happening. Why did the market perform the shift on that area? But clearly on the weekly, we are having this, we are having this liquidity, the area of liquidity on this area, the weekly. So you have to be very careful with the shifts from the 4 hours time frame, because they're actually going to take you down to this area of liquidity. So it's just a matter of waiting, it's just a matter of observing and seeing maybe what the market has to offer. We are currently having a shift on this area, and we are having also a formation, but I won't disclose the FTA for us to confirm this formation before going to trade this formation. So it's going to be, it is what it is. So we also took another pair. It was NZDUSD, and this pair actually it was very nice trading this pair on this previous week. And when you go maybe to the weekly time frame, on the weekly time frame, we had some sort of, wait, do I have to discuss this on the monthly time frame first or whatever? No, just try to look at it on the weekly first. So on the weekly, we're having this area of liquidity. So coming to the 4 hours, but I have to explain the liquidation process on the 1 hour. So let's just try to look at it on the monthly time frame first for your advantage. So on the monthly time frame, if I look at this price action right here, we are having this previous monthly area of liquidity, in which the market came, try to liquidate it. For those who know maybe the second accumulation or the first or whatever, they will have traded this formation right here. So the market performed a shift on the daily, which was this one. And also we had a formation. When you actually know how to deal on the cases of liquidity consumption, you would have taken this entry. But a lot of people are actually avoiding the zones like these ones because of this certain concussion that's actually happening on these areas. But so far, that's not the case. Later on, the market came. So the market came, it actually performed a shift again on this point right here. So we had a daily area of liquidity to liquidate, which was this one. Daily area of liquidity to liquidate. So liquidating this area of liquidity from the daily time frame, we had to perform a shift on the 1 hour time frame. So going to the 1 hour time frame, a lot of people actually know what to do or what to look first before coming to the 1 hour. I think my students know what to do when coming to look at these shifts from the 1 hour, because there are a lot of things actually happening. So coming to the 1 hour time frame, we are having this shift. I don't know how you guys mark this shift, but this is the way I mark my shifts. And we were having this area of liquidity, an inside formation, we call it. I don't know other people actually what calling this, how do they call these areas? And speaking of liquidity consumption, the market actually took some sort of liquidities on that area. So this was actually the best part that was actually remaining. In a 15 minutes time frame, supposedly, if you look at it clearly, we were having this liquidity engineering right here. This liquidity engineering right here. So you would have taken your entry. It was a zero drawdown entry, as you can see. Would have taken this entry on this area, and as you can see from here, so the risk was only how many pips? Only 1.8 pips, as you can see. So when you're having a base broker, you're having a zero spread account, you can actually take these entries in a very, very good particular way. So the market started going down. That means I won't explain deep on the liquidation process, but as long as the daily cycle, the market has already performed the liquidation, you can actually shift on the 4 hours time frame to observe what is actually happening. Speaking of 4 hours, we would have already taken your entry from the 1 hour. So we're just waiting for the market to perform a shift on the 4 hours time frame, which it did on this area right here, as you can see. So here, a lot of people were actually confused. We were having this validation point, and the main mistake was to mark this as an invalidation point. That was the mistake. Instead, this was our invalidation point because the movement of coming to create a new low originated from this point right here and not this point right here. So that means down this was supposed to be my area of liquidity. So you'll actually, because of the nature of this movement, you'll actually have to go to refine these entries on 30. Even if you went on 30, you would have taken the move as usual, maybe somewhere there because the risk is actually enough. But going deeper also, you would have actually go maybe I remember when going to the 1 minute time frame, find some sort of liquidity engineerings, which I found them, which was located on this area right here. This was the liquidity engineering that I took. And I know my masterclass students know also another reason why we took this liquidity engineering instead of these liquidity flips and so whatever. But even if you took liquidity flip as usual, we have actually went to the profits as usual. So no one has to lose anything. So now this was the entry that was taken from the NZDUSD. So as long as you know what you're doing, these pullbacks that are actually happening, they don't have to bother you, because on these entries, a lot of people maybe when they see maybe some sort of pullback like this one, due to emotional reasons, someone may close these orders above right here. But as long as you know what you're doing, you don't have to close, you just have to wait for more opportunities. So the market later on came, and as you can see, the market activated that entry with a risk of only 1 pip. And that's the reason this pair was traded on the previous week. And the market went down like crazy, like hell. So the market went almost how many pips? Almost 99.6 pips with only 1.2 risk to take. Yeah, so you're waiting for the shift maybe from the 4 hours to observe. Or you're going to look at the FTA maybe, if we actually needed to trade these formations from the 1 hour time frame, as long as the 1 hour time frame also has not performed any of the clear shifts. So we are just going to wait for the market to do its thing. Yeah, so that was all about the NZUSD. So we would have actually banked maybe the first entry from 134 pips, and also from the second entry to 99.6 pips, approximately 100 pips. So that was all about the NZUSD. Let's move on to another pair. We were having the silver, and the silver was taken. First of all, the silver was taken from the second agglomeration this year. We had a particular shift from the monthly time from that happened back on the days, it was on 2022, and we're having this as our inside formation from that particular shift. Considering the second agglomeration, we had to wait for the market to enter on this area so that it can actually perform a shift on the daily. And the market actually did perform the shift on the daily time frame on this area right here. In this area, this was the shift from the daily time frame, and this was also your formation. For those who know how to trade the third agglomeration, they know how to take advantage of each and every movement when waiting for this formation, because the market had to fuck around, as you can see on these areas, before coming to the, so for those who know how to trade the third agglomeration, they know what to do, taking advantage of these movements that actually happen. So coming to the 1 hour time frame, refining this entry, in our time frame, we had some sort of, we didn't have a clear liquidity engineering on the 1 hour time frame, as you can see. We didn't have a clear one. Also, some of them may actually take this. I don't know how your broker actually counts those peak value, because some of the brokers may count maybe to approximately 3 decimal place. Some of them are going to count maybe 2. So it depends on the value for a specific broker on a specific pair. So coming to this one, this was a liquidity engineering that was taken, and the risk, if you measure. So looking on the risk from this liquidity engineering, we're having this amount of pips right here, and some of the brokers are going to count this as 59 pips. Some of them are going to count this as 5. So depends on how your broker actually calculates his or her pip values. So this way, the way now the market actually came in, performed that entry from this pair. Yeah, so the market later on came, but also we had another entry from this particular shift that I won't disclose it because for specific reasons, but we had this outside formation right here, so you would have taken your entry on these shifts right here. Later on, so the market will have offered maybe how many people, maybe 403 or whatever. Later on, the market came with that range, as you can see, and market started going down, as you can see. Yeah, so that's how this silver entry was taken. Let's also look another, the Australian dollar compared to the US dollar. And this pair, actually, the entry that was taken on the previous week, we had this monthly area of liquidity. Market actually came to liquidate this area of liquidity from the monthly. So for the market to come to this area, we had to have a shift on the daily time frame. Shift actually happened. Also, the market actually offered some sort of entries. But also, based on the second agglomeration, the market later on came, performed a shift on this area, and also left us with this outside formation. Left us with this outside formation. So you would have actually taken these formations on the 1 hour time frame, finding a specific liquidity engineering trade. So clearly, you would have taken this liquidity engineering right here. And the market, as you can see, how many risk was offered on this area, it was almost 8 pips. Yeah, so the market started going down. And as long as on the daily time frame, the liquidation process has already been done, we also took another entry. It was from the 4 hours. And on the 4 hours, we had a particular shift happened in this area right here. And also we had this as our inside formation. So coming to the 30 for refinement, we had this clear liquidity engineering on this area. I know a lot of people are going to ask, bro, how did you take that liquidity engineering? But majority of them know why did we take, but it's not a must for you to take the first entry. You would have taken maybe the second entry based on the confirmation from these lower time frames. You would have taken maybe this liquidity engineering, that clear reaction right there, and you would have taken the movement as usual. So the market is currently running and measuring from the amount of pips that actually banked in this area. At this sheet where we had this. Let's look at this anticipator. The market went almost 8 pips. And only the risk was only 2.1 pips. So that was how this Australian dollar, US dollar entry was taken. Also, looking at it clearly on the Bitcoin, but if you were wondering why this Bitcoin entry was taken, I just posted a snippet on Instagram clearly, but let us try to look at it. I usually tell people to try to identify those areas where price behaved unfavorably. And considering these criteria, we are having a momentum activity on this particular area right here. So you just have to go and observe what is actually currently happening on these areas. So clearly, for you to for that to be easier for you, the main concept that I'm trying to explain right here, you just have to go to observe those momentum activities, and also you're going to observe those previous zones that are actually happening at that area. So clearly, if we mark, let us use the rectangle. If you mark this area, for example, mark this area. If you go, and on these concepts, we don't have to follow the time frame coordination. You just have to go with the flow. If you go to the 1 hour time frame, we don't observe actually anything on this area. If you go to the 15, if you go to the 30 first before going to the 15, you also don't observe clear area on of this particular momentum. What I mean is by looking at this particular area where we didn't have any sort of disturbances like that, as you can see. If you go to the 15 again, you also don't observe anything. We don't have to observe the zones from these areas because we are actually having this sequence on these areas right here. So you just have to observe those clear areas like this one. And if you go to the 5, also we had nothing on this particular point. Going to the 3, we had this zone. So we are supposed to take our entry on this clear zone right here. But if you observe clearly, this area was consumed. So that's why you had to deal with the imbalance. That's why you had to mark our first entry below that zone. We had to find the imbalance below that area. And also, this was the imbalance. For those who maybe don't know how this imbalance work, according to the principles of supply and demand, the market has to perform a balance on each and every movement that it has to make. And for the market to perform a balance, we have to have something like this one. Sorry, let me try to draw it clearly. We had to have something like this. When we're having this as our first candle, this as our second candle, and this as our third candle, for the market to perform a balance, a clear balance, the weak point from the first candle has to intersect with the wick from the third candle. That's what call it as a balance. But if we have something like this one, if we have something like this, the gap that's actually happening between these two lines, this is what we call as the imbalance. So that's what we did on this area right here. So this is your entry, and this was your stop loss. And from here to here, we almost had how many pips? Almost 14 pips. So that is how this entry was taken. Coming to the 4, try to speed up the simulation. Market came, tap into that entry, and the market now currently running. So you're going to do the same on each and every. Actually, this concept happens a lot on the Bitcoin. So you just have to go and observe those areas where price actually performed or behaved unfavorably. And currently the market went almost 1,035, 1,359 pips. So considering the monthly, we were having this shift right here. We were having this formation. Market came and liquidated it. That means the first target is going to be our reclaim point, which is supposed to be this one. Supposed to be this as our reclaim point. So we are going to wait for the market to come and trigger this entry so that we can see on what to do. Also, considering this EURNZD pair also, we are having if you observe clearly, we are having a shift. Marking the shift on this area was very hard for a lot of people, but we were having the shift on this area right here. This was the shift that happened particularly on this area, and also we are having this formation, this inside formation right here. But for the market to come to liquidate this inside formation, it had to perform a shift on the daily. And coming to the daily, the market first of all performed the shift. People are going to get confused marking on this shift, but I usually mark my shifts based on my rules, and this was the shift that had to been spotted. And also we were having this this area of liquidity as our inside formation from the daily time frame. That means I have to mark this by green. I usually mark this by color codes. So considering the principles, we are going to refine this on the 1 hour time frame. And that is how this entry was taken, considering the 1 hour time frame. Some of you may mark maybe the liquidity insurance, maybe considering the liquidity inducement, which was this one. But also going to the 15, you would have marked your clear liquidity engineering. I don't know, should I disclose it or not? But of course, yeah, maybe. Yeah, so this was the liquidity engineering that was supposed to be used. And the market now, from that particular entry, went almost how many pips before performing another shift? It was almost 436. But remember, the market now has officially entered the monthly area of liquidity. So observing a shift from the daily time frame, we were having a second agglomeration on this particular area. So observe clearly, we had this shift right here. We were having this shift right here, as you can see. Also, this entry was also taken considering the 4 hours cycle. You'll have taken this entry also considering the 4 hours cycle. So after marking this formation now, going to the 1 hour time frame, do you have anything on this area? No, man, don't have anything. Going on to the 15 for more refinements. This entry was taken based on the fourth agglomeration, because there was a lot of some sort of liquidity consumptions happened a lot on this area, but the entry was supposed to be taken on that point right there, and this is how the market can behave on this area. But also you would have taken the confirmation entry because later on the market came again. When the market came again on this area, the market went down officially. So you would have taken based on the confirmation from the 3 minutes time frame after the liquidity engineering from the 15, and it was supposed to be on this area right here. The market later on came, activated that entry, as you can see. So there was no way that you would have missed your movements. So now the market went down from here, almost 150 and more, because the market is currently moving. Market is currently moving, and the main movement that we actually had to do on this area, as long as we already performed the shift on the daily, the market also, after performing a shift and left us with this inside formation, the market also left an outside formation. As you can see, I just need to play it so that I can actually come to look at it. We are having this formation right here, which was also, as you can see, it was clear. But for those who know the FTAs, they know how to take advantage of the movements that we actually had to share from the 4-hour cycle to the daily cycle. But considering this previous price action right here, after the market performed this shift, we were having more than one inside formations. And considering the liquidity consumption concepts, we had to mark on these areas. This was the area that was actually available, and liquidity area available in this area was supposed to be this one. That's why the market later on came and tried to admit. But considering this entry, going to the 1 hour, time frame, some of them may actually mark this liquidity engineering, and this was supposed to be marked because of specific reasons. Not of people know why. So we would have taken this entry, and the market now went down again. So as long as you know what you are doing, you don't have to go out of these trades that you actually take on this area just because of a specific pullback happening on this area. You just have to go to add a lot of, we're going to add a lot of positions. Yeah. So the market went down almost 360. So considering this area, you were supposed to take this entry based on maybe the second agglomeration or the first agglomeration or whatever you are going to take it. But this entry was taken by the liquidity flips, and liquidity flips was actually available somewhere on 15, if not mistaken. Let's try to look at it. 15 was better because of the areas that the market actually had to offer, but also considering the liquidity inducement. Considering the liquidity inducement, the market had to be taken. But clearly, if you observe here, we are having this liquidity flip, which was this one. But the entry, some of us, the entry was taken, but some of the savers, I don't know why these particular savers are having some sort of discrepancies on each and every saver that you're going to find on the trading view. But yeah, some of the entries was taken, some of them was not taken, but clearly we are supposed to trade based on our rules. So you actually trade what we see and not what we believe. Yeah, so some of the entries were missed, but some of them were taken compared to how the discrepancies work with different brokers. Yeah, so that's it. Also considering the another pair, just try to look at it. We are having the USD card. Clearly, if you are observing on the monthly time frame, no, the weekly. On weekly time frame, we were having this shift on this area. We were having this formation, but also we're having another formation inside this area, which was supposed to be this one. So marking this formation, this weekly formation, considering the second agglomeration, if you go to the 4 hours time frame, we had a shift. And the shift was located on this area right here. This was the shift, and also this was my inside formation. This was my inside formation. So considering marking this inside formation, if you go to the 30 now to look at some sort of refinements, in 30, we had this liquidity engineering. But also going further, we have any of the liquidity flips available in this area, or what we have at the moment? The entry we took based on the liquidity engineering, which was supposed to be this, and the risk was almost how many pips? Only 8 pips. As you can see, so the market tried to liquidate the area. So that was the second accumulation entry that was taken based on the USD card. So the market started rallying. And also you would have actually continued to take some sort of continuation of entries based on the shift that the market actually performed. You can see market started rallying, and so far the market was continuing to create more highs. Just let me try to consider this simulation so that we can actually not waste a lot of time. So considering the entry that was taken, I remember it was last week. The entry was taken from the 4 hours, and it was from the shift that happened clearly on this area. Had a shift happened on this area, and also we had this formation 30 going to the 30. We had a liquidity flip, which was this one. Clearly we are having almost how many pips to risk? Only 10. But going more further on the 5 5 minutes time frame, we also had another liquidity engineering, which was this. So a lot of people are going to ask, bro, why, considering the liquidity engineering and the liquidity flip, why did you put more preferences on the liquidity engineering instead of liquidity flips? For those who know the force agglomeration are going to understand clearly what we did on this area. So the entry risk was almost how many pips? Almost 3. And the entry was activated, as you can see, and the market went up. Market is continuing running till now. So you're going to wait for more structures to be made or more structures to be formed so that you can actually know on how to deal with various criteria. So that was all about these pairs, guys. See you on the next video. Focus signing out.